Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. As I said in the last video, today's video is all about this company. We're looking into it today. This company, oops, what just happened there? This company is basically specializes in financial software and services. The company is best known for TurboTax, which is the gold standard in tax preparation software among the US consumers. It has achieved an equal dominant market presence with QuickBooks, which is another thing that they use, which is for accounting software that helps small businesses and self-employed people to basically track their income and expenses. And in fact, Intuit basically holds more than 70% market share basically in the US in both categories, which is quite huge. So we haven't spoken about this company in basically a lot. I've mentioned it a while ago. I was really interested, and then there was other companies that I was interested, so I haven't actually looked into more details. So what I'm going to do today is just to kind of look at the financials and look at what company does and so on. So, but before we do that, if you haven't joined us on the Discord, please do that. Okay. Basically, by joining us on the Patreon account, you can join us on the Discord. Hopefully, we're trying to build a like-minded brothers and sisters that can share, their experience and so on. So, this company basically has been around for quite some time, and it's basically a giant, basically behind the US small business accounting software, which is called QuickBooks. They also have basically TurboTax, which is basically a tax software. Between these two software, they actually each one of these software holds almost about 70% of the market share in the United States. And it has a wide economic moat, okay? And it's one of those companies that work with mainly small businesses and basically self-employed. So if you are self-employed, if you own a small business, you're not going to do your taxes, especially in the US anyway. You're not going to do all your taxes by yourself. You hire this company, you basically use their software, which basically allows you to basically tell you, remember, if you don't pay your taxes, what's going to happen? You're going to end up in prison, right? So the best thing to do is use the software this company has developed to help you obviously make sure that you're paying your taxes right correctly, especially. So what I'm going to do now is, now you have an idea of what the company does, and the main software that they actually develop are these two. But they also have other companies that they've acquired recently. So they do have the TurboTax. They have the Credit Karma, which is another company they purchased in 2020. They have QuickBooks, which I've already mentioned. And they have another company they recently purchased, which is MailChimp. All of these 4 things together gives this company a wide mode. And I think this is one of the businesses that have a pricing power, if you like, because if you're using their software, no matter whether there's a recession or whatever, you're going to have to pay your taxes if you own a small business, right? So you're going to have to make sure that you still have subscription to this software, this company. And one of the things I actually like about this company is they now have the online. So with TurboTax and QuickBooks, it says online sales have eclipsed their respective desktop sales. So instead of the online sales are now better than the desktop. So the desktop is basically where you download the software and you've got it sitting on your computer, you put all your data and so on. But now the online one's actually better now. So Intuit has now basically transitioned into a cloud-first company. And this is really important. So now if this becomes some sort of a SaaS software where people have just subscribed it to every single year and then obviously update it as long as they basically keep updating and so on, that should be great for their customers. And it has a wide economic mode. So I really like the business model. I don't think this is one of those companies that's just going to disappear. I like the fact it's a technology company. It kind of reminds me of Salesforce, but it's a smaller version of Salesforce, if you like. But at the same time, it's been around for a while, and it pays dividend, and it has a free cash flow, and all of the amazing things that we're going to talk about in a second. So let's get into that and just talk about the financials. Now you have an idea of what the company is, basically what the company does. Okay, right. So currently trading $445 for 5-year return is 132%. And they have a positive EPS of $6.81, which is really good. The market cap is 120 billion. So they're not really a small company at all. And they do have a wide economic moat, like I said before. Beta is slightly high. and PE seems really expensive right now. We're looking at this PE of 65 is very high. It's double what the sector is trading at the moment. But the forward PE is actually cheaper. So it tells us basically the company is forward looking, because remember, the PE looks at the trailing 12 months. The forward PE looks at trailing, by the way. This should be trailing PE. This is the forward PE. So the forward PE, we're looking at the expectations, what we expect the company to report in terms of earnings, and then use that to give us an idea where the company should be in the next 12 months. The 5-year average, basically, we're looking at about 40. So looking at the 5-year average is actually still seems expensive, and looking at the free price to free cash flow, it is even seems more expensive. So based on the current PE, the company seems really expensive, and basically the 5-year average as well as the price to free cash flow. So let's have a look at everything else. Now, having looked at how based on PE it seems very expensive. Dividend yield is 0.70, so it's not a lot, but it's for this type of company, it's actually not bad. Remember, it's a technology company. I didn't even expect this company to pay dividends, but they do, which is good. The latest increase, in fact, is actually 15%, which is really good. And the 5-year average is 5-year growth rate is actually 15%. So based on this is really good. This is a dividend growth company. The annual payout, $3.12. That's what you will get for every share of this company that you own. The dividend growth streak is of 10 years. So they have increased this dividend for 10 years. So just again, that's really good. The Cisco, I think, is almost like 12 years or something. Okay. So this is good so far. The payout ratio is only 23%, and the dividend safety is 98%. So far, I like what I've seen on this side, and the fact it has a free cash flow of $4 billion and free cash flow yield of 3.4%, which is again really good. So looking at this side of things, this actually looks good. In terms of valuations, it seems a little bit expensive. But dividend side of things, free cash flow side of things, the free cash flow yield, it is good. Profit margin is good. Return on equity is good. The operating margins is good. So total return in the last basically 10 years, we're looking at about 22%. Again, really good. Basically, return on invested capital, 9%. And the revenue, basically compounded annual growth rate in the last 5 years, we're looking at about 20%, which is really nice. Current ratio, which tells us basically if the company will be able to pay its debt in the basic liabilities in the next 12 months, it needs to be above 1 for the company to be able to pay, and it is above 1, which is really good. Now, in terms of looking at the growth estimates for the next year, we're looking at about almost 13%, and then almost to 15% every year from there onwards, which is really good. So company is growing double digits in terms of earnings. Now, this is probably why, and this is why I've always said to you guys, you can't just look at the PE on its own and just say, yep, the PE is too expensive, I'm not going to do anything with this company. You have to take into consideration the fact that growth expectations. A lot of these basically investors that are looking at the company saying, okay, basically because of the growth, I'm willing to actually take a little bit of risk, right? That's why the company is trading at higher multiples. So let's see what the rest of these analysts actually think. So according to Morningstar, it's actually 11% discounted, just like I showed you earlier. As you can see here, it's 11% discounted right now. Okay, right? According to, so that's $503. That's where they expect the price to be. According to Simply Wall Street, it's actually 8%. So 458 is where they're expecting. According to TipRank, is actually 16% upside, so almost a 500. And according to Seeking Alpha, is 480. So again, that's almost 13% upside. And so according to Seeking Alpha, is actually a buy. So let's have a look at what they've done recently in terms of earnings. So this was the February earnings that they've released, and that was a beat both top line and bottom line. Okay, and they actually basically increased small business and self-employed group revenue 20%, basically to almost $2 billion. Grew online ecosystem revenue 24%, which was 1.4, and so on. Now, looking at where the stock is in the last basically year to date right now, okay, if this works, okay, it's about 13% up. In the last 6 months, about 18% up, and so on. So as you can see, it's gone up quite a bit. So now we're looking at the revenue side of things, okay? As you can see here, annualized from $12.73 billion, we're expecting next year about $14.17 billion, then $15.8 billion. Okay, so it is definitely heading the right directions, and this is also heading the right directions. Now, the one thing I wanted to show you quickly is the ratings. So as you can see, according to Gult, basically it is a hold. According to Seeking Alpha analyst is actually a buy, and according to Wall Street is actually a buy. Now, when you look at this, okay, there's 4 buys, 3 hold, and no sells. When you look at Wall Street, for example, there's a lot more coverage in this company. So strong buy, 16%, 8% buy, and 16 people said is actually a strong buy, 8 said is a buy, 5 said is a hold, 1 said is basically sell. Now, let's continue with the rest. So in terms of Sharia compliance side of things, okay, there's absolutely no issues with this company. They don't obviously did any money exchange, whatever. They are a company that is obviously dealing with the taxes, so people pay. As you can see, they were buying back their own shares, and I think 2021 they start increasing it, and I think that's probably something to do with the deal they actually had, because remember the Credit Karma was actually, that's around the time they bought this company. So that probably explains why this has gone up. But then it's gone up the next following 2 years. So it'll be interesting to see if they if they soon say they're going to start buying back their own shares. So there you have it. The company, it seems really, in terms of the business side of it, it seems really good. It's the type of business that I like to own because, they have a wide economic moat. They have a huge customer base, both self-employed as well as small businesses and so on. They're doing a lot of the online situation right now, the cloud side of things, and I think this company is going to grow faster. I mean, this growth is actually, if you're growing in the business double digits, that's really good. This is what Microsoft and these companies are growing right now. Okay, these basically the mature companies, and this seems is one of those mature companies. Okay, so in the long run, I think this company is going to benefit. Obviously, if we hit recession, that might actually. Because remember, what happens during recession times is a lot of these smaller businesses start losing their start losing customers, which then means they have to close down and so on. That could impact the company. So, but again, I don't think this company will be impacted as much because they have the self-employed as well as that, and we'll see how it goes. But obviously, no one knows that, especially if the US. If they keep saying, you know what, we're not in a recession and we're going to avoid recession, then at least that's a good news for this type of business, right? And final thing I want to show you. So if I have my portfolio basically here, right? And I've got a lot of technology companies. So, and every time I do this type of videos, I always be honest with you and tell you exactly what I would do with a company that I don't own already, like this one here. What am I going to do? What is my plan moving forward? And if you look at my portfolio right now, I've got 25% of my portfolio in technology, and again, this is only dividend-paying companies. Does not include Adobe. So probably if you include Adobe as well, we're looking at about 26%, 27%, okay, if not more. So right now, I don't think I would be adding any technology, okay, because if you look at it, and it's not because I've been buying a lot of these companies, but when you look at, for example, ASML, I bought obviously 8 shares, but it's gone up about 10%, 11% in the last almost 4 or 5 days, right? The other companies, Broadcom, for example, I'm up now almost to 50%, 1,000, almost of £300. Okay, Cisco was down quite a bit, it's gone back up again. Just today. The other one is Microsoft, is basically up again, 1,300 or 50% up of this on this stock. I'm down on Qualcomm, and I'm only showing you technology companies, by the way, and Visa, I'm actually up. So all these companies have gone up quite a bit. So a lot of the money that a lot of the companies that are in the green are the technology companies, apart from Qualcomm. So because of that, is actually basically grew in terms of the overall portfolio's allocation. So 25% is a lot. I don't want to add more to it, so I'm going to leave it for now. But I'm definitely considering basically adding this company to the family portfolio, because like I've always said to you guys, okay, I can't share that portfolio obviously, but I will tell you here and there some of the companies I'm considering. So this is definitely one I'm considering for the family portfolio, considering it's actually down a little bit right now. Seems a great company. I can hold and forget about it, okay, for the next 5 to 10 years at least. So definitely interested, look into it for the next few weeks and so on. And if it basically comes down maybe a little bit even more, I'll probably start nibbling and adding to the family portfolio here and there. If I add it to the main portfolio, you will obviously know about it as well. Anyway, I'm going to stop the video there. If you haven't subscribed to the channel yet, okay, I know a lot of you have not, please do so, because it really helps the channel to grow, obviously, and reach a lot of brothers and sisters out there. If you haven't joined on the Patreon account, just that really helps the channel as well. And then join us on the Discord and let me know if you have any questions. I apologize for not answering a lot of your questions lately, because things are busy at work and so on, and the family, and it's not easy, to trust me, to actually run this thing and at the same time with the work as well as family. But inshallah, I'll do my best. Okay, I'm going to do my best to actually answer all your questions. I've got a video coming up soon to answer majority of your questions, inshallah. The ones that I can't answer, basically I will answer it on the comment side of things. Okay, have a wonderful day. Assalamu Alaikum. Take care.